We had another tough day on Wall Street with the S&P 500 down just under 2%. It was about 1.8% by the time it was all said and done. And the other indices really didn't fare much better. The worst part of it is that we rejected that falling 30-day moving average in all four of our key U.S. equity indices. Much of this was driven by this expectation that the Fed is about to get much more hawkish, as we just saw the worst CPI reading since 1982. Yes, 40 years ago was the last time we saw inflation this hot. And so there is this expectation that we're going to see several interest rate hikes later this year, and that really spooked markets. So we'll talk through all of that, see what it means for our posture. We'll then get into a trade application example where I wanted to focus on selling a put on a healthcare company that already has a very attractive dividend yield and is likely to continue to raise their dividends into the future. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 10th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area and make sure you're signed up for our email distribution list. We're also heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And sadly, it is another sea of red, basically completely eliminating yesterday's gains. And you can see that finding some winners was few and far between. Most of them were somewhat earnings related. So I did just see that Moody's, as an example, was up today. It just announced a dividend increase here. Disney was up off of their earnings announcement here today. They were up 3.35%. Coca-Cola had their earnings today. They were up 0.56%. Pepsi also had their earnings coming out today, but they didn't fare quite as well, as they were underwater here today. They've been outperforming recently, so perhaps just giving back some of their gains. Pepsi did come out with their dividend increase announcement here today, as some of you saw on my Twitter feed. Remember, Pepsi's a little bit unique compared to most other dividend aristocrats out there. In fact, now they are a dividend king, which means they have raised their dividend for 50 years in a row with this announcement this morning of 7% increase. But one odd thing about Pepsi is they announce their dividend increase well in advance of actually paying that. So the increase will take effect in the June payment. In other words, the next quarterly payment will still be under their old rate. So it's a little bit confusing there, but just as a heads up towards this summer, Pepsi has already made that announcement. Also, we did see Philip Morris up here today just a little bit in that consumer staples space. I believe Cisco came out with their earnings here today. This is the food Cisco, not the technology Cisco, so SYY in this case. It was up about 2%. And then Kellogg also had their earnings announcement where they also announced some increases in their boxes of cereal and different things like that, but they were up 3%. Some of you might recall that we actually have an open trade on Kellogg right now. It was a little bit of a peculiar one that I put on many, many months ago, where I sold puts from a leaps perspective, which I traditionally don't do since your time decay doesn't really help you out all that far away. But I wanted to do something a little bit odd just to learn from it, and so far so good. I think we're up about $400 on that trade, but today helped a little bit from that regard as well. So any of you Kellogg shareholders out there, hopefully you got a little boost in your portfolio there today. Otherwise, as you can see, it was bloody red all across the board here. Our major players, of course, Apple and Microsoft, both down significantly, over 2% each for those two. Google was down over 2%. Amazon was down not quite 2%, but over 1%. And then Tesla was down over 2%, in fact, nearly 3% there. So when you've got those big players all in the red that significantly, there's a good chance that the market itself is down pretty significantly, and the S&P 500 was down nearly 2% on its own here today. So not a whole lot to be joyous about here today, with the exception of just a handful of names that benefited from some of their unique earnings announcements. After hours here tonight, we're holding steady the last I checked from the futures perspective. I did see that Zillow came out with their earnings and their stock was trading higher. I think Expedia was as well, but there were a handful that came out and were on the flip side of that. So kind of a wash here overnight as we head into Friday morning session. Let's go ahead and pop on over to the main part of the platform now. And I always like to kind of get started here with this 1% move chart. Give me a second to pull it up. There it is. 6D is the chart for those of you that are following along at home with your own charting package. Remember, that's one of the benefits we offer you here at Market Scholars. If you're a premium member, you have access to all 50 plus of the customized charts that you'll see David and I using in our presentations. I like to pull up this particular chart. Let me get rid of that study up there because that sometimes just gets in the way. There we go. I like to pull up this chart when we have a big day, either up or down, just to give you a sense as to how big of a day was it comparatively, and also giving you a sense of how volatile have we been lately. So as you can see, today was a big down day for the S&P 500. It wasn't as bad as this day back here when I was with you back here on the 3rd. I remember that day I was mentioning how that was the second worst day that we've had in the past year after this day in late February of last year. So it wasn't quite as bad as what we saw there on February 3rd. Nonetheless, this is one of the bigger down days we experienced here over the past year. So it was a tough day. And you can see here that we've had quite a few of these large red bars here in kind of the middle of the screen or off to the right in the middle of the screen. And what that signifies is prices have become more volatile, both to the upside, as you can see some nice big green bars up there, and then also those large red bars down below. This zero line here represents basically no movement throughout the day, and then each kind of color level lower or higher is progressively showing you more and more of volatility. And so in this case, you can see today's move pushed us down below the 1% level there in blue, but not quite to the 2% lower level there in orange. But we've had a number of those types of days where we're just shy of a 2% loss in the market ever since really kind of getting started this year, right? We started off at a high level calendar year 2022, and then 2 days into it, we topped out. That's 2 trading days in, so that was January 4th. And then, pretty much right after that, we got this candle here on the 5th. And you can see all the other red candles that are coming in after that down below. So these have not been quiet days that we've had so far in 2022. This has definitely been a step up in volatility compared to what we were used to back in 2021. Another way to kind of judge that is this purple line down below. This effectively is where the VIX is at this moment in time, and you can see that we rose to about 24 on the VIX. That's not particularly aggressive, at least compared to where we were at back here in late January. You can see in late January we had several days in a row of selling off. Today effectively just gave back yesterday's gain. So while the VIX was up today, it wasn't nearly as violent or dramatic as what we were seeing at the end of January, where it seemed like the sell-off was happening day after day after day after day. So we'll see where that takes us. It doesn't mean that it can't go higher from here, but just be aware that we're kind of in just an average zone for the VIX right now. We were at about 20 here just yesterday with the big move higher, and then we advanced to about 24 here today. So remember, all else being equal, if you're selling options premium after a big up move in the VIX, you traditionally have a benefit there. And so we'll kind of get into that conversation a bit more at the end of tonight's presentation as well. Let's go ahead and do our breadth check. And so let's come on over here to the Market Watch tab, click on the Visualize area, come over here and select the Index Watch, and then come over here to the public watch list and select the S&P 500. And you can see it was a pretty broad-based selling type of a day, not quite like a big 95% down day or anything like that, but definitely more than an 80% down type of a day in terms of components in the red here. Only 66 stocks managed to close higher here today, so probably not the luckiest of numbers there to begin with, 6.6. But in addition to that, just the sheer selling of 439 of the S&P 500's components gives you a sense that there were very few places to hide here today. In fact, you could take that conversation a step further, and you wouldn't be able to hide in the bond market today. You wouldn't have been able to hide in the cryptocurrency market today. You really wouldn't be able to hide much in the commodities market today. So there weren't a whole lot of places that ended up in the green today, let alone just the stocks struggling. It was tough out there with interest rates rising, and a big reason behind that is the inflation numbers came out. So CPI numbers came out at a 7.5% year over year level, which was basically the highest reading for the CPI, at least the core CPI, in 40 years. It's my birthday today. I happen to be 44, but that puts that into context. Basically, I was 4 years old the last time that the inflation readings were as high as what we received today. That puts us all the way back to 1982. Many of you probably weren't even born at that point that are listening to this right now. So this is kind of uncharted territory for a lot of newer traders out there that aren't familiar with how to operate within a higher inflation type of a market. And we're all going to kind of learn that together, because even though I was alive back then, obviously I wasn't trading when I was back in those elementary types of days. So I'll be learning right there along with you. But the general philosophy out there is that when interest rates rise, heavily indebted sectors and industries tend to struggle on a relative basis, because naturally, if you're used to running your business on high amounts of debt and you need to constantly refinance that debt at ever higher rates, then more and more of your corporation's profits and cash flows are heading to debt financing costs with those higher inflation. And if there's more interest rate pickup in years to come, you can expect that more and more of your potential profits as a shareholder of the business is going to be chewed up by the bondholders that are going to demand those higher interest payments as a result of all that inflation that's taking place out there as well. So it's a little bit more of a precarious time here, and one that even folks that have been trading, in that higher inflationary environment, those of you that were maybe born in the 1960s or what have you, you might have long since forgotten. Back in the 80s, very few retail investors were actually trading on their own. They might have had a broker that they would call up, and the broker kind of made the decisions for them. So we're going to be learning a lot about the markets together here in the coming years, I have a feeling. And we did hear from Bullard from the Fed here today, and he was saying that he's expecting 100 basis points hikes in the interest rate environment by July. And that kind of spooked the markets. Markets were actually hanging in there pretty well earlier today. But after that started coming out on Bloomberg, all of a sudden the markets just, kind of went into a tailspin after that. Even beyond Bullard, market participants in general are now expecting a 64% chance of a 50 basis point hike in March. You don't need to check your calendar. That's next month. And so, this is an environment where a lot of market participants feel like the Fed is behind the curve. When we are showing inflation at the highest levels in 40 years, and we still have historically low interest rates right now, you might see an environment where we are seeing the Fed get really hawkish in a hurry here as we head into the summer, as they try to get grips of this inflation that's starting to take over, at least here in the United States. Interestingly enough, inflation over in Japan still isn't all that much. It's still at kind of the under 2% level. So inflation isn't necessarily taking place all over the globe, but here where we've had a lot of quantitative easing and some reasonably strong economy and a lot of government incentive programs during the COVID time period, all that kind of mashed up into a situation where prices of services and products are rising. We haven't raised our prices here at Market Scholars, by the way. So for those of you that are looking to get a relative bang for your buck, I suppose you could say that there are a few places that are holding the line on their pricing. But who knows? Maybe that's in the cards for the future, because it seems like everywhere you look, prices are going higher over and over and over again. We're seeing, that conversation showing up with like Clorox the other day, with Unilever here recently, talked about it already with Kellogg. I mean, we're seeing company after company after company coming out and saying, we can't control this inflation, so we're going to do our best to raise prices because we can't control the inflation on the cost side of the equation, so we need to raise prices on the end selling side of the equation in order to try to maintain that margin for our shareholders. So it's going to be interesting to see which companies are going to have pricing power moving forward. Even myself, I just got an email here within the last week or so from Netflix saying that, oh, by the way, your subscription is going to be going up here starting next month. So even, Netflix, with their content production costs going higher, they're raising their costs. And, I think for the most part, they offer a fairly reasonable service for the costs. And so I don't think I'll be canceling my Netflix, but who knows, maybe other people will be. But those types of companies do have pricing power. Other companies may not. And you might find yourself in a situation where you're kind of sifting through the available stocks out there. And what ultimately makes your decision as to what you want to invest in is which companies have pricing power to be able to raise the costs of raise the prices of their services and goods. And those are the ones that are most likely to be able to maintain profitability moving forward. And some of the other companies that are less higher quality types of companies might be on the outside looking in. So it's going to be a very interesting environment that we're going to find ourselves operating in throughout 2022. Let's take a look at some other charts here. Let's do our traditional 4-grid chart now. And this is chart 4B for those of you following along at home. And as you can see, the S&P 500 was down 1.81% today. Notice that it was basically just a give back of yesterday's gains. So, we're still not trading as low as where we were just on Monday at this point, despite what seems like a shocking, sell-off here that we saw today. We're still trading higher than where we were on Monday. So all we did was get rid of yesterday's gains and part of Tuesday's gains. So it's not nearly as aggressive as it could have been in otherwise, right? Over here, this was very aggressive because it was happening day after day after day after day. Who knows? Maybe that's on the horizon, right? Just like I mentioned to you guys on Tuesday, it is my expectation that we're not out of the woods yet. The sellers have not gone away. They are still there, and they're looking for opportunities, right? One of the trades I did here recently with the bearish trade on Danaher, that worked very nicely today. Danaher was down like 3%. So there's sellers out there, and they're looking for opportunities. They're trying to pick their spots. And I think we happen to be at a point right now where the sellers could come out of the woodwork in a hurry because, this is a fearful position for me where we are just a hair below the falling 30-day moving averages on all 4 of our indices. So again, I've been paying more attention to the moving averages than I have the posture of the market forecast, and I've been very upfront with you on that. It's not that I don't respect the market forecast and what it's telling me, but this is a market where I'm trying to figure out where the path of least resistance is. And there was a lot of damage done to the stock market here in the month of January. And so I tend to think that when you see broken support levels all over the place, like we saw back here, that this still is a market that is a sell the rips market, not a buy the dips market. Not to say that you can't selectively buy certain dips, right? If they're really high quality businesses that you've been wanting to tuck away for years and you're given that opportunity, you might very well seize upon that. But that's from a long-term investing perspective. What I'm referring to is short-term trading. And right now, I think the bears still have the upper hand in this market, despite us being up and off of those lows nicely from the end of January. I still fear the possibility that this downward trending 30-day moving average is going to act as resistance, and we got our first taste of that basically today. And we did not fare well from that perspective, at least if you want to be bullish, because you can see we are bouncing down and away from the S&P 500's moving average. The Dow looks a little bit better, where we were at least able to close above the moving average yesterday, but today, as a follow-up to that, was pretty poor because we're now back down below that falling moving average. The Nasdaq Composite tested it today at the highest level of its trading, ended up with a long upper shadow there, not a great look. And the same thing can be said for the Russell 2000. It tested it today as well and rejected it. So it's not to say that they can't get above them, but right now their first attempt at it was not a successful one. This is not a great look for the markets as we kind of head into the weekend, because tomorrow could pick up the selling further, and that could kind of confirm that today's move was the correct one. In other words, the sellers are correct to be selling stocks here in a higher inflationary environment where a lot of companies are going to be challenged to maintain the same profitability that they had in years past. So this is not the best looking market from my perspective right now, and I surely hope that I'm wrong, because I can promise you I have way more exposure on the long side of the market than on the short side of the market. So when I say this, I don't enjoy saying it, but I have to give you the message that my eyes see, and what my eyes see right now is that this is still a market that's in trouble, and we've got to be careful where we pick our spots. So the good news, I guess, if you're looking for it, is that all four of these major market indices have bullish intermediate postures. That's what the green background colors are telling you there, with the Dow Jones the strongly bullish posture, all the rest weakly bullish. So that's the good news. But the bad news is it didn't help them today, right? What was hurting them today was the rejection of the 30-day moving average. So until we're consistently trading above those moving averages, I'm not really going to trust what the posture is telling me on the market forecast in this type of environment where we've got broken charts all across the board. So it is what it is, but it was a tough day. To put a ribbon on it, S&P 500 down 1.81% today. Dow Jones held up the best. Remember, that's the theme that I've been trying to harp on for the last couple of months with you guys. The Dow continues to be the leader, and while down 1.47% doesn't sound like a leadership group, it is on a relative basis. It was down the least amount here today. Nasdaq Composite struggled today. A lot of those growth stocks on the downside. Nasdaq was down 2.1%, and then the Russell 2000 was down 1.55% here today. So not a great look there either. Now, we can take a look at the 3 green arrows chart, but remember, we already kind of know what it's probably going to be telling us, which is we still don't have 3 green arrows because none of these charts are trading above their 30-day moving average. So in this case, we did have 3 green arrows briefly there yesterday on the Dow, but we gave that back here today. Got the red arrow back there as it's back below that moving average. So we've got a mix of green and red arrows across the board, which was the exact same thing as what I had mentioned to you guys on Tuesday as well. Let me pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support the Market Outlook video. Remember, we don't get paid to do this, and it takes about 3 hours of our day all in to do the research and the prep work and deliver the video and do the editing and the uploading and the rendering and the processing and the writing of the paragraph and the sending out of the emails and the updating of the social media notifications. There's a huge process there. And we don't force you to join a paid a paid user group like a Patreon. I hear a lot of people talking about Patreon these days. We don't force you to do that. We don't force you to listen to a whole bunch of advertising from Blue Apron or some other crazy company that has nothing to do with trading. We're just here to deliver our content to you, and we ask one thing in return: help support us on social media. We don't have a big advertising or marketing budget as a small business, as you can imagine. So our best way to get the word out about our premium services is through word of mouth. So we're hoping that by providing free content to you guys every day on YouTube, it will eventually pay off in the form of some folks deciding to take their education to the next level and signing up for a premium subscription that we offer. So anyway, thank you to those of you that help support that the last time around. 110 of you clicked like for me the last time around, and so I can't say thank you to all 110 of you, but thank you to Michael and Prickly Trader and Ron and Kenneth and Dennis and TFR and Sarah and Mary and Ken, Jayesh, Chris, Roger, Kirk, Jerry, Paul, Ken, Victoria, Gerald, Doc, Chris, and Fred and Ray and Jim, Carl, Surendhar, and everybody else, right? I can't go through all 110 names, but I do appreciate you. And we do see your notifications coming through, so we know who you are, and we know that you're out there supporting us, and we really do appreciate that. Without the support of our community and on social media, I don't think we would be able to do these videos. It really just, we couldn't justify the amount of time from a monetary perspective, and therefore we won't be able to do the videos. So keep it up on your end. As long as we're up and over 100 likes on Twitter, I'm happy to do a full-length video for you the next time I do it, which in this case will be Tuesday. Hopefully I'll have a big smile on my face with a Rams Super Bowl victory. But regardless, looking forward to being with you there on Tuesday. If we're under 100 likes, then I will plan on just doing a quick hitter type of a video where it's just a 15-minute video with no trade application example. So I'll let you guys collectively decide if you want a full length or a kind of a shortened version of that. But again, thank you to everybody that supports us. Also, earlier today in our premium classes, we had a great session as always for my Q&A session. David taught his portfolio management with ETFs class in the afternoon, so feel free to check out the recordings of those classes if you happen to miss them. We had some great questions as always here. We had a question about new market as a potential dividend growth investing candidate, and talking about our short put win streak, which by the way is 2 years long now without a loss on selling puts, and that includes here in the market outlook video that I do them, right? I can't speak for David, so I can only speak for my paper money account. In addition to my Monday afternoon options for long-term investors class, where we pretty much exclusively concentrate on sold puts. So 24 months in a row, in other words, 2 years in a row without a loss. Now, I'm going to stress that because there's a pretty decent chance that next week will be the last week that I'll be able to say that, because one of our trades from my Monday afternoon class, VF Corp, is going to be, it's going to come down to the wire as to whether it's going to be a successful trade or not. So the market's down the next couple of weeks. There's a pretty decent chance that our 2-year win streak will come to an end. But it's been a wonderful streak, and I hope some of you have been able to participate with those winning trades along the way. Also got a question about interpreting various charts that David and I present to you from one of our newest market scholars. I also got a question about asking me, when do I usually place my sold put trades throughout the day, and how do I go about the process of fishing for better prices. I also got a question about how to locate average dividend growth rates. For example, with Pepsi raising their dividend 7% this morning, I showed an example of how that would have been considered an attractive dividend increase for Pepsi's purposes over the last 3 years, but not quite as attractive over the last 5 and 10 years. Also got a question about 3M and some of its struggles lately with various lawsuits and things like that, and whether investors should be concerned. I also got a question about Vertex as a biotech company that's been partnering up with some CRISPR companies, and my thoughts on that. And then I got the best question of them all, which is who will win the Super Bowl? And of course the answer to that is the Rams. Of course I'm just teasing you guys. I know there's a lot of Bengals fans out there as well, but I'm looking forward to a fantastic Super Bowl weekend there. Also, while we're over here, let's check out our factor selector tool. Remember, I update this on Tuesday nights, so it's a couple of days stale at this point, but I don't think we'd have dramatic changes since then. Be aware that dividend yield continues to carry the day. Now, this is on a relative basis, so remember, when stock markets are struggling, there's always going to be some category that's doing better than others, even if that group is not up on an absolute basis. But right now, there are a number of blue chip companies within the dividend yield category that are holding up reasonably well. Value comes in at number 2 once again, and low volatility comes in at number 3. Quality comes in at number 4. Momentum actually got off of the bottom position. Momentum had been dead last for about 5 or 6 weeks in a row, so they're now second to last and has been replaced at the bottom by low size. So remember, this isn't always cut and dry, but given what I've shared with you on the 4-grid analysis over the last few months, there probably isn't a big surprise to see things shake out the way this is. Because if you think about like the Dow Jones Industrial Average, the blue chip index that I talk about regularly, that's effectively your dividend yield category, right? Most of the companies within the Dow do pay a dividend. If you're thinking about, Coca-Cola, and you're thinking about Procter & Gamble, those are your big blue chip types of companies, your Johnson & Johnsons. Those are your Dow Jones types of companies. So in a lot of ways, there's some pretty good overlap between the Dow Jones and the dividend yield factor. You could also say that the Russell 2000 has a lot of overlap with the low size factor. And of course, the Russell 2000 has been one of the worst performers of the 4-grid here more recently. You could probably get away with saying that the Nasdaq is probably the closest to momentum, as you have a lot of kind of hyper growth types of companies that are overlapping in those two categories more traditionally. And you might be able to say that the S&P 500 itself kind of represents the quality area. Remember that a stock like Microsoft would be considered a quality stock, as it's one of only 2 stocks in the United States, along with Johnson & Johnson, that has a AAA balance sheet according to Standard & Poor's. And so we have a S&P 500 right now that I would call a quality index. I don't know if I would go as far as putting Tesla in that group, but I would certainly put Microsoft and Apple and Alphabet. Those types of companies are quality businesses. So, given what we know, the Dow Jones / dividend yield is outperforming on a relative basis. The Russell 2000 / low size is underperforming on a relative basis, as is the Nasdaq / momentum, and the S&P 500 / quality is kind of in the middle of the road right now. Let's go ahead and pop on over here now back to the Thinkorswim platform, and let's do some 12-grid analysis, starting with chart 5A. So a reminder that when we're looking at these miniature charts here, that the background colors of the charts will tell you what the current market forecast intermediate posture is. And so, as I've already alluded to in this presentation, there wasn't a whole lot of places you could hide today. You saw that the 10-year Treasury was the big story of the day. So the 10-year Treasury yield crossed up and over 2%. Now, that's actually the first time we've been up and over 2% since July of 2019. So this has been a rather epic move here on the 10-year. The 2-year is moving quickly as well, by the way. So a lot of those different interest rates are moving higher, but a lot of times people kind of judge interest rates in general using the 10-year, as it's usually the most popular. So be aware that if you're trying to sock money away in a savings account, it's entirely possible you're going to start seeing some more legitimate rates in the future. It's been a while since I could say that, right? For a while there, it was, you could kind of switch from online bank to online bank and try to find those higher interest rates, but then interest rates just plunged and that kind of went away. Well, if we start seeing interest rates going higher in a big way, which we've seen the infancy of that movement already, it's possible that you're going to start getting paid to have CDs and other things like that down at your local bank. We'll see if that happens or not. I think you still have better opportunities within the stock market, but for those of you that want more of a safe and capital preservation type of experience, perhaps down at the local bank will get you done. Of course, inflation might eat you alive, but at least your capital won't decline in value like you might see with other more speculative asset classes out there. So that was the big story of the day. And as you can see with these 12 grid charts, the only other chart that was green today was the dollar. So that was it. Interest rates went higher, so that was green, and the US dollar ticked a little bit higher. It was up 0.16%. But otherwise, you had red across the board. Commodities were down. Gold was down 0.38%. Oil was down 0.33%. That's USO at least. WTI, I think, was up just fractionally. But oil in general, across the landscape, was down a touch. You saw cryptocurrencies down just a little bit. Bitcoin was down 1%. Not a big deal there. But you saw all the bonds, of course, down because interest rates spiking higher means bonds going lower, all else being equal. So high-yield bonds were down 1.3%. Foreign bonds were down 0.71%. And then TLT, which is long long-term U.S. government treasuries was down 1.59%. This one has been a little bit more painful for me to watch because, of course, I've got an open bullish position on it. Luckily, it wasn't an aggressive bullish position. It was a bull put spread. And remember, the further we go down below 137, we're capped in our losses with that particular trade. So if we do have some sort of a spiraling out of control event for interest rates in the coming week and a half, our trade cannot get any worse because we did the 139, 137 bull put spread. Interestingly enough, just a week and a half ago, I could have closed that down at profits. In hindsight, I wish I would have. Of course, I don't have a crystal ball. But trade was doing just fine up until about a week and a half ago, and then boom, we just had this huge move lower right here. And so, unfortunately, that trade is not looking like it's going to turn out to be a successful one. We'll see. We've still got another week or so to see how things play out. But right now, with it trading below our long strike, anything below 137, we're covered. That's the nice thing about that particular strategy where we sold a spread, right? That's different than when you're selling a cash secured put all by itself. And that's part of the reason I chose to do that. Remember what I said at the time when I placed a trade. I have no desire to be long the bond market. What I thought when I was placing the trade is that things had gotten a little bit oversold to the downside, and I was willing to test that theory. It's looking like testing that theory is not going to be working out successfully, but at least I was wise enough to put it into a spread type of a trade where I know what my worst case scenario is when I place that trade. So when I sold a put, I also bought a put as part of that spread, and that bought put is effectively our hedge embedded within the trade itself. So that was a big mover there, and you don't see this type of destruction on long-term U.S. government treasuries all that often. This is a very aggressive sell-off that we've had since the beginning of the year. And then on the top rung, you can see we were red across the board there as well. I already told you about the S&P 500, but even across the globe, developed foreign stocks were down 1.27%. Emerging foreign stocks were down 0.66% today. And then preferred stocks were down 1.36% today. So you couldn't hide really anywhere today. If you got lucky, maybe you were in the US dollar, but that's probably a very small representation of this audience. So if you lost money today, guess what? Welcome to the club. Most of us did. Just one of those days. Let's go ahead and take a look here at our next 12 grid, which will be our sectors 12 grid. Now, we had a clean sweep to the downside today. Every single one of our sectors was lower in the United States here today. The best of the losers was actually materials. They were only down 0.58% today, and then that was followed closely by energy, down just 0.62% today. Those two do remain with the green background colors as well, so they're kind of in the mix of kind of our leadership group. Energy is our true leader right now. Materials is just kind of vying for, let's call it honorable mention there. But I still think that the financials chart looks a lot better than something like materials at this moment in time. And so those were our best performers today, both of them down 0.5%. Our worst performers today really got clobbered. You can see down below here in the lower right-hand corner that real estate was down 2.85%. Technology was down 2.6%, and utilities were down 2.53%. When you see those three sectors down that much and being our laggards in the market, it should tell you one thing cleanly, and that is interest rates are likely spiking that day, right? The two bottom ones, it's a little bit more obvious for what I told you before. Utilities and real estate are heavily indebted sectors, and therefore the higher the interest rate environment, the more their margins are going to be pinched because their bond financing charges are going to be going up in all likelihood in the future. And they don't have a tremendous amount of pricing power in most cases. Remember, utilities are heavily regulated, so they have to work with regulators just to pass through any price increase. Kellogg said this morning that they're going to increase the prices of their cereal. They didn't have to clear that through any regulator. Utilities actually have to ask permission to do that. So they're going to be in a particular bind if regulators are not willing to work with them and respond quickly. That's the other challenge is, interest rates are moving quickly. how quickly can the utilities go to the regulators and say, we need to increase our electricity rates or our water rates or natural gas rates or what have you. So those two, it's a little bit more obvious. Remember, there's also a little bit of a bond trade-off conversation that takes place there. Sometimes when interest rates are really low, investors choose intentionally not to invest in bonds for their income portion of their portfolio, and they choose to use utility stocks and REITs as kind of bond-like proxies. If interest rates start heading higher, then those same investors who were once investing in utilities and REITs might very well sell them and go back to the bond market if the bond market is giving them acceptable types of yields, like I mentioned before, 2% now on the 10-year Treasury. So we'll have to look to see how that will play out moving forward as well. Technology getting beat up when interest rates go higher is a little bit less obvious, but it comes down to kind of the discounting cash flow models out there. And a lot of times investors are willing to give technology companies with bright promises of the way distant future the benefit of the doubt when interest rates are low. But when interest rates start going high, then investors start demanding that those types of companies be profitable right here, right now. So that's why you're seeing a lot of those Cathie Wood types of stocks really get bludgeoned in a rising interest rate environment as well. So that was without a doubt the story of the day. Interest rates basically had some sort of a either direct or indirect reason behind most of the major moves that we saw here today. All right, so let's now get into our trade application example. And many of you know that I'm a big fan of selling puts, going back to that 2-year win streak that I had mentioned before that might be coming to an end next week. We'll all see if that happens or not. I think VF Corp would have to close below, I think it's 64.30 to have our win streak come to an end. So that's entirely a possibility there. So we'll find that out. But I do enjoy selling puts, and I particularly enjoy selling puts on days when the stock market is getting hammered. And the reason for that is volatility plays a key role in the Black-Scholes model that effectively prices out options contracts. And volatility plays a role alongside price and time. Remember, when you're a put seller, time is always working in your favor, right? That's one of the few guarantees in the world, is that time will pass. And so when you're an option seller, there's a mechanism within the pricing model that will benefit you a little bit every single day as time goes away. Remember, that's also on the flip side, your enemy when you're buying calls and puts. Every single day, there's a slight portion of the pricing model that is eating away at the value of your long calls and puts. So we know that as put sellers, time is always helping us. Volatility and price have the opportunity to either help or hurt us depending upon when you're placing your trades. If you're placing your trades after the stock market sells off, like was the case today, so let me just pull up the ticker symbol in question. It's going to be Gilead Sciences, ticker symbol GILD. Then you get the benefit of volatility kind of pumping up the premium. Remember, if you're buying that premium and it's getting pumped up, you don't necessarily like that because you're paying more for that premium than you were the prior day. If you're the seller of that premium, you might look at that as a positive thing because now you get to sell a contract at a more expensive rate today than you would have been able to yesterday, even if the price of the underlying security was exactly the same. The volatility itself effectively ensures that you're selling a juicier premium. And so, a lot of that, is kind of, ties together in my mind where I want to be brave and I want to sell puts and do something bullish on a day when the stock market is getting hammered. I almost force myself to do that personally. A lot of times, as long as the market's down at least 1%, I'm going to go hunting around for opportunities to sell puts. So let's talk about Gilead here in this particular case. Remember what a put sell is effectively doing. Most of you are aware of this, but remember we also have newer folks that watch these videos as well. And when you're a put seller, you are effectively putting yourself on the hook to buy a stock at a lower price. So like I always teach my students in my Monday afternoon class, only sell puts on stocks that you actually want to own. We had this conversation here, a few sessions ago as well on Clorox. So I'm going to start my conversation with that. If you have zero interest in owning Gilead Sciences, just disregard this trade application, right? You should only sell puts on companies you actually want to own. Gilead is not the most popular healthcare company out there, but it has had a nice string of success from a biotech's perspective over the years from their product portfolio. In some regards, they're actually too successful because they're actually curing Hep C and some of these other diseases that are out there. And of course, that's a great thing for society, but it's a tough thing for a business model when you make money off of selling pills and other treatments. So they're kind of in a strange kind of debate, moral debate, as it were. It is what it is. I'm not going to get into that particular part of the conversation. All I can tell you is that their cash flows and their sales and their earnings have made this biotech company a consistent raiser of the dividend ever since they started paying it. You can see they started paying this dividend back in 2015. And every single year, faithfully, you see this dividend stair-step line jutting higher, telling you that the company is awarding yet another dividend increase. And we did just hear from them yet again recently. It wasn't the biggest increase ever, but nonetheless, they did hike that dividend from 71 cents up to 73 cents. Not only that, but this company already has a very attractive dividend yield. You can see up here in this black label up at the top, their current yield is 4.73%. And this is a company that also sells that drug remdesivir that many of you have probably heard about during this COVID era. It doesn't necessarily cure COVID, but it helps those that are hospitalized as a result of COVID. So they've had a little bit of a sales boost from that particular drug and kind of put them front and center in conversations about healthcare during the COVID era. However, you can see that 2022 has not been kind to them. This kind of dotted gray line that you see right here represents the crossover. So we ended last year at around 73 bucks, and this stock has basically gone straight down for the first 4 or 5 weeks of 2022. We're now down about $12 per share since where this thing closed at the end of last year. Naturally, most of you are aware that when a stock's price goes lower, its dividend yield goes higher. And it's up to you to determine if that means it's an opportunity, whether that's more attractive, or whether you think that there's justification for why the stock is selling off. In this case, I can tell you that the stock is trading at a dirt cheap PE ratio. It's trading with a payout ratio that's also quite conservative. And so I personally don't have any reason to believe that a dividend cut is on the horizon with this one. I think that the path of least resistance for this company is to continue to raise dividends in the years to come. I don't have any idea what that means for the stock price, but what I'm after as a dividend growth investor is a consistently rising stream of income, and I think Gilead is the type of company that can provide that. So what I did with today's trade application example, and remember those of you that are premium members of Market Scholars would have received my notification at the end of trading today. It was about 10 minutes to go before the session closed up because I wanted to wait until towards the end of the session today as this was a downtrending market day. And remember, the more that a company has been beat up before you sell the put, the better off you are. So sometimes I get the trades done earlier. Today was one of those days that I intentionally held off until towards the end of trading. But about 10 minutes before the market closed, you would have received my notification there on Telegram. Anyway, the trade that I did was selling the March 5750 put. And I think we got, I don't remember what it was. It was like 80, somewhere around 82, 83, 84 cents, somewhere in there. In other words, more than a 1% return on risk for my willingness to buy this stock at 57.50. Now, the reason that 57.50 is kind of interesting from a technical perspective is you can see that that's exactly where we put in kind of a double bottom back here in 2020. If I were to zoom into that area right there, you can kind of see what I mean. So 57.50 is approximately right here if you can kind of look at my crosshairs on my chart. So notice that here in October of 2020. It was trading right around 57.50, and then again it kind of tested that level one more time here in December of 2020, where it was right there around that $57 level that ultimately put in kind of that double bottom that you see right there and right there. And that's effectively where I'm putting myself on the hook for buying this company if the stock continues to fall, right? If the stock does not fall down below 57.50 on expiration day there in March, then that, that $85 or whatever it was that I took in today is mine free and clear to keep, to do whatever with. If it does go down below 57.50, then I need to be on the hook for buying 100 shares of it there. So interesting kind of setup there from a technical perspective as a result of that double bottom from a company that is highly likely to continue to raise their dividends in the years to come, and one that is already perceived as attractive from a yield perspective, with a yield close to 5% here in real time, that struggled from a price perspective so far here in 2022. So that's what I had for you here today. I hope you got value out of this presentation. Again, my birthday here today, so thank you to all of you that sent me your well wishes as well. Some of you saw the cake that I posted there earlier. I'm looking forward to digging into that tonight. I have one birthday wish as I will blow out my candles, and that will be, let's get a Rams Super Bowl victory this weekend. My second wish will be, I hope you guys will click like for me there on Twitter. How about that? So again, we appreciate your guys' interest in these videos. We hope you get value out of them. We hope our time is worthwhile that we spend with you here, and we hope to see you all in our premium classes one day down the road as well. So with that, I want to wish you all the best of success with your trades and your investments. Have a wonderful Super Bowl weekend, and I'll see you all on Tuesday. Take care, everybody. Bye-bye.